Welcome to Talk Tickers, where we dive deep into the latest earnings calls. Today, October 14th, we're tackling the Q3 2025 results from Goldman Sachs. They just dropped intraday.
Yeah, and it's a really interesting one to unpack. We've got these huge headline beats, right? But the market reaction was, well, kind of muted.
Exactly. So our mission today, figure out what's behind those big numbers, understand the strategic shifts, especially this move away from consumer banking and why the market seems focused on expenses.
And this new AI efficiency drive they announced. Lots to get into.
Okay, let's kick off with the results themselves, just the raw numbers, because they look pretty stellar on the surface. GAAP EPS was $12.25.
Right, which absolutely smashed consensus. I think the street was looking for something around $11.10. So a really significant beat there.
And the top line, revenue?
Also very strong. Total revenue hit $15.18 billion. Again, consensus was closer to, $14.2 billion, so nearly $1 billion better than expected.
Wow, and that's like 20% growth year over year?
Yeah, 20% YoY growth. And that translated into a pretty healthy ROE, return on equity, of 14.2%. Solid numbers all around.
Okay, so solid numbers, big beats, which naturally leads to the big question. Why did the stock basically go nowhere on the day? Finished maybe slightly down.
That's the disconnect, right? It seems the market just latched onto the expense story, the cost trajectory. Despite the fantastic revenue performance, the narrative immediately shifted to worries about spending, especially non-compensation costs. Investors seem concerned about cost discipline, even with all this deal activity.
Okay, well, let's talk about that deal activity. Because the engine this quarter was clearly investment banking. It felt less like a recovery and more like, I don't know, a boom.
Absolutely. I mean, look at the IB fees, up 42% year over year. That's huge. Came in at $2.66 billion.
42%. And advisory was even stronger.
Yeah, advisory revenues surged 60% YoY to $1.40 billion. Seems like a lot of deals that were in the pipeline finally closed this quarter, a heavier completion calendar.
And underwriting looked pretty good, too.
Both strong. Equity underwriting up 21%, debt underwriting up 30%. That debt number reflects more leveraged finance activity picking up again.
And Goldman loves to talk about league tables. Did they mention their position?
Oh, you bet they did. They made a point of saying they've advised on over $1 trillion in announced M&A volume so far this year.
$1 trillion? Seriously?
Seriously. And they said that puts them $220 billion ahead of the next bank. They threw out examples, too, like being the exclusive advisor on that huge electronic arts sale, $55 billion, and financing the Dayforce LBO.
Okay, so they're clearly dominating the current wave. But what about sustainability? Is this just a one-quarter pop?
Well, that's where the backlog comes in. Management highlighted that their quarter-end backlog that's advisory, equity, and debt combined is at its highest level in 3 years.
3 years. Okay, that's significant. That suggests this isn't just a flash in the pan.
Right. It points towards maybe 12, even 24 months of continued strength if that backlog converts.
So if the backlog's that strong, why are investors still hung up on, cyclicality and near-term costs? Shouldn't that backlog data calm those fears?
Logically, yes. But, markets can be short-sighted. Sometimes they focus on the immediate expense number rather than the future revenue potential. But supporting that backlog story, they also mentioned positive signs in private equity. Sponsor activity is apparently tracking 40% higher than last year.
Wow.
And there's still about $1 trillion in dry powder sitting with sponsors, just waiting to be put to work. That's a pretty powerful tailwind.
Okay, $1 trillion in dry powder. That definitely helps. Let's shift gears then. Away from IB, what about the more sort of stable parts of the business? Global markets, trading.
Still resilient. This was actually the 7th quarter in a row of year-over-year revenue growth in global markets.
7th quarter, okay.
FICC, that's fixed income, currencies, commodities, brought in $3.47 billion, up 17% YoY, and equities did $3.74 billion, up 7%. So, solid performance.
But wasn't there a strategic angle here too? Something about financing revenues?
Yes, exactly. This is really key to their strategy. They're pushing hard to build more durable fee-like revenues within the trading businesses. And they hit a record in equities financing revenue this quarter.
A record? How much?
$1.7 billion just from equities financing. And if you combine the financing pieces from both FICC and equities, it totals $2.88 billion for the quarter.
Okay.
And here's the important part. That financing revenue now makes up almost 40% of the total net revenue in global markets.
40%. So that really shows the shift towards more predictable income, even within trading.
Precisely. It's a deliberate move towards stability.
And that stability theme carries right over into asset and wealth management, AWM, doesn't it? More records there.
Absolutely. Record assets under supervision, AUS, hitting $3.5 trillion.
$3.5 trillion.
Which naturally leads to more fees. They also hit record management and other fees of $2.9 billion.
And the flows, are they still getting inflows?
Get this. This was the 31st consecutive quarter of long-term fee-based net inflows into AWM.
31 quarters in a row.
Yeah.
That's incredibly consistent.
It really is. That's the kind of durable growth story investors like to see. And it's why they felt confident enough to raise their target for alternative fundraising this year. They're now expecting to pull in around $100 billion.
Okay, $100 billion target for alternatives. So AWM is clearly a core pillar. Now let's talk about the big strategic announcements, the modernization efforts. Part one seems to be cleaning up the past, specifically the consumer stuff.
Right. That multi-year simplification plan is nearing the finish line. They confirmed the sale of the GM credit card program is done.
Okay, GM card is gone. What about Apple Card?
Still pending, technically, but they were very clear, again, that credit cards just aren't part of their future strategy. They want that capital deployed elsewhere.
Which brings us neatly to part two, efficiency, and this big announcement. One Goldman Sachs 3.0 propelled by AI. Sounds ambitious.
It does, doesn't it? It's positioned as a major multi-year overhaul of their operating model, centralizing things using tech.
And they were quite specific about why now, right? It wasn't because revenues are weak.
Exactly. They framed it as leveraging technology, especially AI, to fundamentally change how they operate, to automate, gain scale, and ultimately free up resources for investment, not just cut costs because they have to.
Okay, but look, we hear about AI efficiency drives all the time. How much of this is real and how much is just, buzzwords to distract from the current expense numbers?
That's the $1 million or maybe $1 billion question, isn't it? How quickly can they actually deliver tangible savings from this?
Did they give any specifics on where AI would be used?
They did mention a few areas, things like sales enablement, making client onboarding smoother, which can be incredibly complex, and manual automating regulatory reporting, even vendor management.
So focusing on those back and middle office functions.
Seems like it. The idea is to use AI to reduce the manual work, freeing up people for tasks that actually generate revenue or directly serve clients, create operating leverage, basically.
And alongside this internal efficiency drive, they're still making moves to grow, particularly in AWM.
Yes, a couple of notable things there. They acquired Industry Ventures, which is a venture capital platform.
Okay.
And they announced a strategic collaboration with TAACREF. The goal there is to offer more public and private market solutions to retirement and wealth investors. So plugging gaps and expanding reach.
Got it. So strengthening the AWM platform while trying to make the whole firm run more efficiently. Let's circle back, though, to the expenses, because that's what seemed to spook the market. $9.5 billion in total operating expenses.
Right. And the number that jumped out was non-compensation expenses, up 14% year over year.
So what drove that 14% jump?
Well, part of it was transaction-based costs, which, makes sense if IB fees are up 42%. More deals mean more related expenses.
Sure, that's logical.
But there were also increases due to litigation expenses and, interestingly, higher charitable contributions.
Okay. But wasn't there a positive sign on the compensation side?
Yes, and this maybe got overlooked. They estimate the full-year compensation ratio will be around 32.5%. That's actually down 100 basis points, a full percentage point from last year.
So pay as a percentage of revenue is going down.
Exactly. It means revenue is growing faster than compensation costs, which suggests underlying discipline, even if the non-comp line looks high this quarter.
Okay, that's an important nuance. Let's talk risk for a moment. They mentioned using more synthetic risk transfer, or SRTs. Sounds a bit like complex financial engineering. Should we be worried?
Yeah, it can sound alarming, but management really tried to frame it as just routine risk management. Nothing extraordinary.
So what are SRTs in simple terms?
Essentially, they're using derivatives like credit default swaps to transfer the credit risk of specific loans off their balance sheet to other investors. It's a way to manage their capital exposure prudently.
Okay, so not necessarily a red flag, just active portfolio management.
That's how they presented it. They also tackled concerns about private credit exposure, saying their book is very diversified, mostly collateralized, investment-grade stuff, maintaining tight underwriting.
Got it. And finally, looking ahead, what about the regulatory environment? That's always huge for banks.
They sounded quite positive, actually. Used the phrase quite constructive on the direction of regulation.
Constructive how?
They expect real progress and clarity on several key things through the first half of 2026. Specifically, the GSIB surcharge.
That's the capital buffer for being a globally systemic bank.
Right. Also, relief on the SLR, the supplementary leverage ratio, and getting the final rules for the Basel III endgame finalized.
And why is getting clarity on GSIB and SLR so important for them?
Because it dictates how much capital they have to hold against their assets. More clarity, potentially lower requirements, means they can operate more efficiently. They think it will improve their competitive stance against non-banks who don't face the same rules.
Lowers the cost of being a big regulated bank, essentially.
That's the idea, and it frees up capital.
Which they can then use for.
For offense, as they put it. Their main capital ratio, CET1, is already strong at 14.4%. They returned $3.3 billion to shareholders this quarter through dividends and buybacks.
Okay.
But once the rules are clear, they expect to run with thinner capital buffers than they have been, which means more firepower for buybacks, maybe acquisitions, or just investing more in growth areas like AWM.
All right. This feels like the perfect time to put on our metaphorical hedge fund caps. It's time for the not financial advice segment.
And we have to stress, this is purely for discussion, maybe a bit of fun. It is absolutely not financial advice. Please don't trade based on this.
Definitely not. Okay, disclaimer delivered. So, based purely on synthesizing this earnings call, what's an outrageous but plausible trade idea?
Given that incredible transactional momentum, IB fees flying, coupled with this simultaneous launch of a major AI-driven efficiency plan, the core trade idea is long Goldman Sachs, short a basket of peers who are less dominant in capital markets.
Okay, long GS, short the less transaction-heavy banks. Unpack the rationale there. You're betting the market's got the expense story wrong.
Pretty much. I think the market's being short-sighted, focusing too much on these Q3 non-comp expenses, which seem partly driven by the very revenue surge they should be cheering. They're missing the bigger picture. Goldman is absolutely capitalizing on the cyclical rebound in banking while also launching the structural OneGS 3.0 initiative to tackle costs long-term using technology.
So it's about the combination, capturing the cycle's upside and investing in structural margin improvement at the same time.
Exactly. And you layer on top of that the potential for a more favorable regulatory regime freeing up capital in the next year or two. The trade bets that as the market shifts focus from Q3 costs to that longer-term structural story efficiency gains, capital return Goldman will outperform.
Interesting. Betting on the market eventually seeing the forest for the trees, so to speak.
You could put it that way. Betting on the strategic vision eventually overriding the near-term noise.
Okay, so to wrap up our deep dive on Goldman's Q3, a quarter really defined by, well, that massive transactional momentum, especially in IB.
Yeah, combined with that clear, ongoing push into more durable fee-based businesses like financing within markets, and especially asset and wealth management.
And then the big strategic overlay. This major pivot towards AI-driven efficiency with One Goldman Sachs 3.0 aimed squarely at addressing those expense concerns long-term.
Which creates the central tension for investors, right? About the reality of current expenses versus the promise of future efficiency gains from AI. How much do you believe the promise, and how quickly?
Which leaves us with our final provocative thought for you to consider. What's the actual present value of this One Goldman Sachs 3.0 plan? And maybe more importantly, how fast does Goldman need to prove these efficiency gains are real and structural, not just talk, to convince the market and earn a re-rating?
Something to think about as you do your own homework.